Welcome back to More Wealth Retirement Talk. I'm Dave Moore alongside Shauna Moore and Jacqueline Gladhill. Shauna, you mentioned a conversation recently that immediately made me think about a question we hear all the time.
Yeah, I think it probably touches on a question that a lot of people have actually.
Is this the trustee conversation that you've been talking about?
It is. And what struck me was that although that conversation involved a trustee, the question itself is much bigger than that. The question was really, how do you determine whether professional management is actually worth the cost?
And that's a question people ask in a lot of different ways, right? Sometimes it's, why should I pay management fees? Or why can't I just buy index funds myself? Or here's another one. Why do I need an advisor when I can use AI?
Ooh, and I think a lot of people listening have probably wondered or at least questioned one of those things.
Exactly. It has come up. And, in this particular situation, this conversation, it came up because someone who is going to be serving as the trustee for assets belonging to our clients' grandchildren was trying to determine whether paying management fees would actually be in the beneficiary's best interests. But the more we talked, I realized the issue wasn't really necessarily about the fee only. The real issue is about responsibility that the trustee is going to have.
And that's what we're going to unpack today. What are you really paying for? What does professional management actually provide? And how does that compare to doing it yourself? But before we get into all of that, how are you ladies?
How are you, Jacqueline?
I am good. I feel like I'm, living the dream right now, you guys.
Really? Do tell.
I don't really, we'll just keep it at that.
Okay, perfect.
How are the two of you?
We're good. We're actually going to be going to an event this weekend in Nashville. Do you want to tell our listeners about what we're doing?
Yeah. There's a Riley Green meet and greet. So we're going to go stand in line tomorrow. He's coming out with a new bourbon. I guess is that a free Riley Green plug?
Oh, I guess it kind of is.
Yeah, he's signing some bottles. So we're going to go down there and, of course, battle the traffic. They have the big Alan Jackson concert tomorrow night with all the stars. So it's going to be pretty packed downtown, but we'll fight through it.
We're
excited. Are you going to camp outside?
Pretty much.
Like back in the day at Tower Records.
I'm so jealous. And if you get pictures or if you just so happen to get something signed for me, let me know.
Yes, we'll say sign it to Dave, Shauna, and Jacqueline.
Yep.
I love it. Well, it's great to see you guys, and I'm excited about this topic. So let's dive in.
Yes.
It's a big one.
Welcome to More Wealth Retirement Talk, where finance meets fun.
Join financial expert Shauna Moore,
sports analogy pro and dad joke king Dave Moore,
and Jacqueline Gladhill, who keeps us all on track
as we break down retirement planning with insights,
laughs,
and a whole lot of more wisdom.
So before the break, we were talking about a conversation Shauna recently had that really got us thinking about professional management fees, DIY investing, and even AI. And Shauna, I think this started with someone who will be serving as a trustee for assets belonging to a client's grandchildren, right?
Yeah.
Walk us through that conversation.
Absolutely. So the conversation I had recently, again, the person is going to become the trustee for assets belonging to our client's grandchildren. And he raised what I thought was a very thoughtful and prudent question. And his concern essentially was, if these accounts ultimately belong to the grandchildren, how do I justify allowing management fees to be paid for those accounts for maybe the next 10, 15, 20 plus years, because in this situation, the grandchildren don't totally have access until they're 30, and some are under the age of 10. So, it's a fair question. He wasn't asking from the perspective of someone looking to necessarily save money, but he was asking from the perspective of someone trying to fulfill a fiduciary responsibility. And he wants to make sure that he's doing what's in the beneficiary's best interest. But, as we talked, I realized there's another side of the conversation, because if he decides not to use professional management, what is he taking on personally? Now he's responsible for every investment decision, every allocation change, every rebalancing decision, every distribution, every market downturn. Every decision essentially made on behalf of those grandchildren for potentially a decade or two. And that's when the conversation started to shift, and it stopped being, how do I justify paying this fee? And it became, how do I justify taking all of that responsibility on for myself? And you still have to decide which weighs more heavily. But being a trustee isn't just about managing money. It's about managing responsibility.
And I think that's where people immediately start looking at the fee differently, because now you're not just talking about investments. You're talking about oversight, accountability, and making decisions on behalf of somebody else's future.
Exactly. And the fee becomes the focus when the real issue is the responsibility.
And let's be honest, investing today has never been easier. I can open up my phone and buy an ETF in about 30 seconds.
Yeah.
I can watch a YouTube video, listen to a podcast, ask ChatGPT a question. So I understand why people think, why not just do this myself?
And Dave, that's a great question. I think a lot of people listening probably feel that way. I know I've even been there.
Yeah, absolutely. And I have friends who manage their own investments, and some do a pretty good job. So I don't think this is a conversation about whether people are capable. I think it's a conversation about what they're taking on when they decide to do it themselves. Because managing investments sounds easy when markets are going up, right? Everybody feels like a genius in a bull market.
Yep.
But the real test comes when life gets complicated, when there's adversity, when you're retired, when the market drops, when you're taking income. When you're responsible for somebody else's money, that's where things change.
Yes. And that's such an important distinction, because again, buying investments is easy, but managing wealth, that's what's hard. That's what's difficult. And most people think investing is the challenge, but sometimes the investments are often, they're the easy part. The difficult part is everything surrounding them. How much risk should you take for your situation? How much income can you safely withdraw? How do you manage your taxes, and how should beneficiary designations be structured? Things like what happens when one spouse passes away, and how do you protect assets for future generations? Like with this recent conversation, those are wealth management questions, and an index fund doesn't answer those questions.
Let's talk about that, because I think a lot of people use those terms interchangeably, investment management and wealth management. Shauna, can you explain the difference?
The difference is huge. Investment management focuses on managing your portfolio. Wealth management focuses on a person's life. So investment management asks, what should we invest in? While wealth management asks, how does everything work together? And what I mean by that is income planning, tax planning, estate planning, long-term care, risk management, beneficiaries and legacy planning, social security decisions, when should you take social security, healthcare decisions, all those moving pieces have to be coordinated. That's wealth management, not just what investments do you have in your portfolio.
Yeah. And I think this is where people get hung up. They look at a statement and see a management fee, and they think that's a lot of money. What's the biggest misunderstanding here, though?
Well, I think what we found is the biggest misunderstanding is that people think they're paying just from investment management for choosing the investments. But what they're really paying for is wealth management. The investment management fee on their account statement is simply how the relationship is billed. At least here with us at More Wealth, we don't charge hourly. We don't send invoices every time a client calls. We don't charge separately when we're helping clients evaluate long-term care options, or when we're reviewing beneficiary designations, or if we're speaking with attorneys or CPAs. All of that is included in that one fee. And so it's not just about choosing those investments and managing that. It's all those other outside things that we don't charge separately for.
All included, kind of like an all-inclusive vacation, right?
Yeah.
You can go on vacation and pay separately for every meal, drink, activity, excursion, or every little thing you do. Or you can choose an all-inclusive resort where everything is bundled together and available when you need it.
Yeah, that's actually a really, really good analogy. It's pretty much exactly what we do, because clients aren't hiring us for one transaction. They're hiring us for an ongoing relationship. They want a team that's looking at the entire picture, not just the investments. And if all we did was manage investments, honestly, I'd agree that the fee conversation would be much harder. But that's just not what we do. We help clients make better financial decisions year after year.
And I think that that's probably where people can get the most stuck. They can see the fee on a statement, but they can't necessarily see all the work and planning happening behind the scenes. It's kind of the convenience factor of it too.
Exactly. The fee is visible, but the value often isn't, because the greatest value isn't always measured by investment performance, which obviously we want good performance, but sometimes it's helping a client avoid a costly mistake, or helping a widow after losing a spouse, or helping a family navigate through a difficult transition. Sometimes it's helping clients avoid unnecessary taxes, or a trustee fulfill fiduciary responsibilities, and all the behind the scenes with that. So things don't necessarily show up on a quarterly statement, but they can have a tremendous impact on someone's financial future.
Yeah, and here's something that we kind of always talk about with different situations. Sometimes the biggest value is something that never happens. It's the unquantifiable, a mistake that gets avoided, a problem that gets identified early, or like a tax issue that gets caught before it becomes expensive.
Exactly. I mean, it could be something like we've had clients come in and they didn't realize they were supposed to be taking required distributions on an inherited IRA account. So the most valuable thing that we can do is sometimes preventative, and that's hard to measure because clients never experience a negative outcome. But avoiding one major mistake can be worth far more than years of management fees.
And just like in sports, I mean, the work is done behind the scenes. It's not the work that we see being done in the week. We see stuff on the weekends, but we don't get to appreciate what's going on the entire week. And I think, another thing people don't always appreciate is that, because they see the meeting. They don't necessarily see everything that happened before the meeting.
And that's exactly right. They'll see the 1 hour review that we sit down with them, but they don't see the hours of preparation, the analysis, the planning, monitoring, the research, the meetings with portfolio managers, and the continuing education, compliance reviews, conversations again with other professionals such as attorneys or CPAs. A lot of that value actually happens when the clients aren't even in the room with us.
Yeah. And I guess if we had one of those reality shows, people would see you up at 11 o'clock at night or 12 o'clock on your computer, doing that deep dive. Mm-hmm. It's, similar to doctors. You don't pay the surgeon for the hour in the operating room. You're paying for years of experience, and everything went into making good decisions. Can I do that part again? Because I feel like I skipped a word or two.
Oh, yeah, you can do that.
Okay. You don't pay the surgeon for the hour in the operating room, right? You're paying for the years of experience and everything that went into making good decisions.
It's another great explanation analogy there, Dave.
Dave, you're on point today.
I was saying, he's kind of on fire.
I haven't even used baseball as an example yet, so stay tuned.
Oh, yeah, I'm looking forward to it. Yeah. I do want to touch on something that Shauna mentioned earlier, about being proactive instead of reactive. And I know that this is a common theme that we do discuss often on this podcast, but Shauna, let's go into further depth on what that means exactly.
Well, a reactive relationship waits for problems to happen. That could be in some traditional structures with certain advisors where they just plug in some investments, might look at it a couple times a year. They really kind of waiting for the client to call and say, hey, I have a problem. Hey, what happened to my, value of my investments? But a proactive relationship looks for them before they happen. So, many financial mistakes occur because, again, people didn't know there was an issue. We're looking at things and constantly reviewing the investments, how they're doing, what's going on with the stock market. We're proactively managing that, but we're also looking for things like tax opportunities that may come up, income strategies, the amount of risk in a portfolio, estate planning concerns. When we talk to clients, we see, we might need to make a beneficiary designation, or maybe there's something going on with legislative changes that clients aren't aware of, or there's healthcare concerns. Maybe there's changes with Medicare insurance, long-term care planning. So sometimes things come up and we're proactively looking at those and making sure that we're reaching out to our clients when those things when we know they might affect them that they otherwise wouldn't think about. So a lot of the most valuable conversations happen before the client ever realizes that there could have potentially been a problem, rather than reacting and waiting until they come in and say, oh, this happened. How do we fix this? And maybe it's too late to be fixed.
Well, another good analogy. I'm full of them today. Law enforcement, security, right? It's unquantifiable how many lives that law enforcement saves. Everybody wants to see a number, but they don't see what's going on behind the scenes and to make things preventative. Are you going to wait? Let me ask you this. If you're going to run a city, are you going to wait until there's a bunch of crime to hire a police?
Right.
You're just not. If you own a business, are you going to wait until it gets broken into to set up that security system? No, that security system already needs to be in place to be preventative. But again, sometimes you're not going to see that come out quantifiable numbers.
Mm-hmm.
And honestly, that's probably where the greatest value comes from, are the problems that never happen.
Yep. I agree with that. Yep.
So let's tackle the index fund conversation, because that's usually where DIY investors start. And honestly, when people say they can invest themselves, what they're usually talking about is buying a few index funds and leaving them alone.
Yeah, exactly. And let me say this clearly, index funds, they can be excellent tools. They're low cost, they're efficient, they're appropriate for many investors. So this isn't an argument against index funds. We've used them in certain situations ourselves, but I think there's a misconception that simply owning an index fund somehow means that you're properly invested. And that's not necessarily true.
I think that is a common misunderstanding. And what do you mean by that, Shauna?
Well, just because you're invested in an index fund doesn't mean you're invested appropriately for your goals, your risk tolerance, or your situation. It also doesn't mean you're properly diversified. So a lot of people assume that an S&P 500 index fund spreads risk evenly across 500 companies, but that's not really how it works. The largest companies can have the largest impact. And in recent years, a handful of stocks, what, many people call the Magnificent Seven, have been responsible for a significant portion of the market's gains in the S&P 500. So what happens if something happens to one of those? They have such a heavy weight on the S&P that if one or two of those companies falters, what happens in the index? That's where you have like a 2008 where that index can drop. So while someone may think they're broadly diversified, they may actually have much more concentration risk than they realize. And those index funds aren't necessarily a conservative investment. They tend to be more moderately aggressive, which might be more aggressive than someone's risk tolerance.
And I think that's what surprises people. They hear the word index and automatically assume lower risk.
Exactly. We've had that conversation many times, and an index fund does not eliminate risk. The stock market can be very volatile, and the S&P 500 has experienced significant declines throughout history. So, simply owning an index fund doesn't automatically mean that you're taking the right amount of risk for your situation. So the real question is not, am I invested in an index fund? But the real question is, am I invested appropriately for my goals and my ability to tolerate risk and volatility?
Because a 35-year-old saving for retirement may need something very different than a retiree taking income from their portfolio, right?
Yes, absolutely. And that's where the planning comes in, because an index fund doesn't tell you how much risk that you should take. It doesn't tell you how much income that you can safely withdraw. It doesn't help you navigate a bear market during retirement or help you with surviving a spouse that might pass away. It certainly doesn't help a trustee fulfill fiduciary responsibilities, and it just doesn't coordinate your overall financial life. It's just an index fund, and that's all it does. So it doesn't do anything else to help your situation.
Yeah. And I just want to say, yet again, it's not that index funds are bad. It's that they're only one piece of the equation. And Shauna, you touched on, the crisis mode, and it doesn't fix that.
Exactly. They are certainly a tool, but they're not a complete wealth management strategy.
So now let's talk about AI, because I know a lot of people are doing this. I've asked AI financial questions myself, and honestly, it's pretty impressive.
Mm-hmm. I think a lot of people have probably tried that by now.
Absolutely. And some of the answers sound really good. But what struck me is this: AI can answer the question you ask, but it can't always answer the question you didn't know you should have asked.
That's a good point. And don't get me wrong, AI is an incredible tool. We use it ourselves, but it's not perfect. That's for sure. Sometimes it's far off base and you have to redirect it, but I would not personally rely on AI alone to manage my life savings. And I certainly wouldn't recommend that someone treat it as a fail-proof financial plan, because AI is only as good as the information you give it, the way you ask the question, and the assumptions behind the answer.
And even if someone says, well, I'll just tell AI my budget, my beneficiaries, my spending, my goals.
Exactly right. And they can, but that still doesn't mean that AI knows what information is missing. It doesn't know whether your assumptions are accurate or verify whether your estate documents match your beneficiary designations. It's not going to coordinate things with if you have a CPA or an attorney. It's not going to know exactly whether your risk tolerance on paper matches how you'll actually react when the market drops. And from our experience, we've had a lot of clients that will come in and they tell us, oh, I'm super aggressive. We go through risk questions with them and actually have a conversation and find out they're actually more moderate than they thought, or we've had the reverse. And so AI is not going to be able to sort through and truly figure out what your risk tolerance is. And it's not going to sit across from your spouse and your family when life changes. And inevitably for all of us, it does.
Yeah. So what you're saying, Shauna, is it's not whether AI is useful, because let's be honest, it can be. It's whether it should be relied on as the whole plan, and it's missing the emotional aspect.
Exactly. AI can provide information. There's no questions about that. But wealth management requires judgment, experience, accountability, and then ongoing oversight. And most importantly, AI is not accepting fiduciary responsibility for your future. So, while the information is valuable, information alone is not wisdom. And when you're talking about someone's retirement, their life savings, their spouse, their family, their trust, I don't think pretty good isn't as a good enough answer. It needs to be on point.
Mm-hmm.
And another thing people sometimes misunderstand is professional management. They think advisors are sitting around picking stocks all day, or they think a portfolio gets set up, put on autopilot, maybe somebody glances at it once or twice a year, right?
Right. And that's a lot. Yes, a lot of people think that, but that's not how we operate. So, at More Wealth Partners, we partner with professional portfolio managers whose full-time job is analyzing markets, managing risks, monitoring portfolios, and making investment decisions. So we work with managers such as Gradient Investments and Market Guard and others, where they spend every day focused on portfolio management and investment oversight. And, so that's what they do. And that's part of our team to make sure that we're not just relying on just AI or just ourselves. We have a full team behind our clients' portfolios.
So how does that relationship work? Because I don't think clients are actually working directly with those portfolio managers.
Correct. We do, but our clients work directly with us. We're their advisor. So we're the ones sitting across the table, learning their goals, understanding what their concerns might be, helping them with retirement planning, income planning, taking their estate planning into consideration. We're discussing tax strategies, beneficiary reviews, and all the other aspects of wealth management. And then based on that, we work directly with the portfolio managers to determine which strategies and which portfolios are most appropriate for each client. And sometimes, even clients are going to have multiple accounts. So with those different accounts, they might have different portfolio managers altogether, because not every account necessarily has the same objective.
So it's not like you're handing someone off and saying, good luck, call this other company.
No, not at all. The client relationship stays with us in office. We're coordinating everything. The portfolio managers become part of the professional team working on behalf of our client.
And that's where I think people miss the advantage. Because if an advisor is trying to do all the planning, all the client meetings, all the investment research, all the portfolio management, all the market monitoring, and all the service work themselves, there's only so much time in a day.
Exactly. And a ball is going to get dropped, and so that's one reason why many advisors naturally become more reactive. They're stressed across so many responsibilities that they're forced to focus on whatever issues right in front of them. But our model allows specialists to do what they do best. So the portfolio managers focus on managing portfolios. We focus on helping our clients make smart financial decisions and coordinating all the moving pieces of their financial lives.
So it sounds like your clients are getting an entire team worth of professionals then, rather than just relying on the one person to do everything.
Yes. And importantly, we want to make this clear. They're not paying one fee for wealth management and then another fee for all the additional expertise and oversight. It's built into the relationship under one single fee. So clients aren't paying one fee for the portfolio and then one fee for us. We partner with them together. We split that fee because we believe, even if that means that we have a lower fee, it creates a better outcome for our clients. And that expertise that we're bringing to the table with those portfolio managers is incorporated into the overall relationship and fee structure. So they're benefiting from professional portfolio management and comprehensive wealth management working together.
And that's a big difference from simply putting money into an investment and checking on it once or twice a year.
Absolutely. This is not a set it and forget it approach. These are professionals that are monitoring risks, again, market risks, risk exposure, economic conditions, portfolio positioning, and investment opportunities every single day. And at the same time, we're reviewing the planning side of the equation. And that's what creates a truly active wealth management relationship rather than being passive.
Absolutely. Well, I like to do this towards the end of an episode, but Shauna, I mean, if someone only remembers one thing from today's show, let's just highlight it. What should it be?
I don't know if there's one thing, but I'll say this. The question isn't whether you can do it yourself. Many people can, not everyone, but a lot of people can. The question is whether you want to take on all that responsibility that comes with doing it yourself, because wealth management isn't really just about investments. It's about, helping you make better financial decisions, having someone proactively look around the corners and be looking at the market all day, which if you're working still or if you're retired, do you want to be doing that? It's helping you avoid costly mistakes and truly having a team to help coordinate all the moving pieces of your retirement portfolio and your financial life. And so I think that's, those are the questions is, do you want to do it yourself?
Yeah, everybody wants to be an investor, but they don't want to be a risk manager, right?
Correct.
Yeah. So if you'd like a second opinion on your retirement plan or your investment strategy, or simply want to understand whether you're receiving true wealth management, we'd love to have a conversation with you.
You can give us a call, 833-4-MY-WEALTH. That's 833-469-9325. You can also visit us at More, that's 2 O's and More, MOORE, wealthtalk.com. And if you like a complimentary copy of my book, Retire with More, The Holistic Approach for a Relaxed Retirement, we'd be happy to send you one. Just give us a call or reach out through our website and request your complimentary copy.
Well, thank you for joining us, listeners, on another episode of More Wealth Retirement Talk.
And be sure to subscribe wherever you get your podcasts and share this episode with someone who's wondering whether they should manage everything on their own.
And remember, retirement isn't just about building wealth. It's about protecting it, managing it wisely, and creating confidence for the years ahead. We'll see you next time on More Wealth Retirement Talk. Thanks for tuning in to More Wealth Retirement Talk with Shauna,
Dave,
and Jacqueline.
We hope you enjoyed the mix of financial insight,
sports wisdom,
and a few dad jokes along the way.
Join us next week for more ways to plan smart,
laugh often,
and retire with confidence.
Advisory services are offered through More Wealth Partners, LLC, an investment advisory in the state of Tennessee. Insurance products and services are offered through More Wealth Management, LLC, an affiliated company.